It's 2021 and we are hopefully coming out of COVID lockdown. Welcome to the latest Skadi Podcast. In episode 10 of the Skadi Podcast, Damian talks with Nick Cowan, Group CEO of the GSX Group. The GSX Group is driving the digitisation and tokenisation of the traditional financial and securities markets using digital ledger technology and aims to establish a new global financial ecosystem involving investment banks, brokers, stock exchanges, issuers and regulators. Damian and Nick talk about how DLT will overcome many of the inefficiencies in the current financial markets and discuss the issues for regulators and the three lines of defence. In a wide-ranging discussion, they also look at the recent Gamestop short squeeze and the Securities Borrowing and Lending markets.
So hello everybody and welcome to the 10th Skadi podcast. I can't believe we've got to 10 already. Today I'm very pleased to have Nick Cowan with me. Nick used to be my boss many moons ago and has since moved out to Gibraltar and works in the crypto space. We thought it'd be really interesting to just sort of dive into this space a bit. I've done a lot of work on it myself and I just think it is a really fascinating space with the developments that have been going on there, not necessarily just the sort of the headline stuff, which is the price of Bitcoin, et cetera. I mean, I think the price of Bitcoin is slightly leading people astray. I think there's some very interesting stuff going on, more in the sort of, especially in our space, the sort of decentralized finance space. And I think, Nick, you probably best really to kick off with just how you've got to where you are, and then a bit of a rundown on what you do, and then we can sort of back some ideas around, especially around the sort of control side of things. But anyway, over to you, Nick. Thank you.
Yeah, sure, Damian. Thanks everybody for having me. And I think there's these, as you know, Damian, our background is traditional sort of capital markets, and we started off down here opening the exchange in Gibraltar a few years ago. And at that time, in parallel, it'd be fair to say that it was very early days. I think Coinbase was probably about the only exchange really that had started at that point. And we had been approached to structure a asset-backed security that invested in Bitcoin. Now, bear in mind, this was 2015, and it was actually at $300. And the client I was with said, the great thing about this is it only goes up. And of course, me being a traditional guy said, it's very dangerous to say that. I think he's now living on a $100 million boat, and I'm stuck in a spare bedroom talking to you, Damian. So it's I guess he's the smart one, I'm the schmuck. But we ended up with this structure, which was actually a prospectus directive approved asset-backed security that could be passported, and it was an asset-backed security that invested in an underlying SPV that invested in Bitcoin, and that was really our first entry into understanding the risk, opening an account at Coinbase, understanding what a cold wallet was. This was all new to me. And the regulator at the time here had to go on that journey with us. And from there, that was really the start of our entry into understanding perhaps that there was something interesting happening in digital assets. And that kind of kicked off the evolution for us to then get to where we are today. And we've been, I think what we've tried to do is to say, look, let's stick to what we understand. What we understand is traditional financial products and capital markets. We understand the post-trade side and obviously the whole control environment. But what you're seeing and what you've seen is so much innovation happening, even if you like from the basics, which is T-instant. Effectively, if you're on an exchange and you buy Bitcoin, obviously subject to you withdrawing, you're effectively long of that asset immediately. And that innovation that we've basically seen all the way through to, as you said, Damian, with DeFi now, where you're looking at the securities borrowing and lending industry, and DeFi has just gone, well, we'll just get on and do it with bearer assets, and you're looking at things like Uniswap, etc. There's so much happening. So what we want to try to do is say, okay, we see really digital securities being the core competency and really the core opportunity for us. I think there's nothing wrong with having 500 exchanges all trading Bitcoin, but ultimately, I think when you look at the size generally, I mean, BTC, I think has just gone through a trillion or whatever it is, but you look obviously the size of capital markets generally, and it's 100 trillion. It's absolutely enormous when you look at the size of bankable assets. So that whole capital market push and trying to see if we can, provide innovation to actually what is a relatively efficient system. It's been going for decades, etc. But we think that by going from T+2 to T instant, you can address some of those inefficiencies that failed trades. 6% of equities currently fail according to ESMA. Counterparty risk is systemic in a T+2 environment. We'll talk about Robinhood maybe a little bit later, but that's an example. You have lack of interoperability between geographies. Generally, it tends to be quite mono geography. And I think if you can bridge that traditional capital market with digital securities and then link in the innovation of DeFi, I think that's probably the paradigm shift that we're going to see over the next 5 to 10 years. And we want to be right in front of that, and I think our vision when we set out really a few years ago was to say, okay, we understand all the post-trade stuff. Can we deploy innovation to make the wheel spin faster? And if we can we also therefore tackle some of those problems and some of those challenges where you can have potentially a bunch of, let's just say, financial partners? They don't have to be exchanges, and they can all interoperate with each other off a single infrastructure. And that's been the road we've gone down. So we've been spending a lot of time investing in that, and we're just on the brink of now taking on our first exchange in Asia for digital securities, in Q2, Q3 this year. So that's kind of been our journey, Damian, from sort of 5-6 years ago, where honestly we didn't really know what on earth this thing was, to now saying, okay, there's so much happening here, we need to be in front of it.
That's great. A good intro to what you do. I mean, I think certainly from what you read a lot of the press around decentralized finance, a lot of people are sort of saying, oh, these guys are going to sort of eat the banks for breakfast, there'll be no need for banks, etc., etc. I think that is obviously a slightly naive thought process. Obviously there's a lot of intellectual capital tied up in banks. I think the banks are starting to realize that actually blockchain can sort some of the issues they have, and I think it will take time. There's no doubt that this thing is going to be switched on tomorrow. It's almost that we've come from an era of, for instance, a lot of netted settlement, a lot of netted custody type stuff, and actually we're now, if you can move to a single type of chain that smart contracts, whatever, exist upon, then you can solve a lot of those problems. But you have to sort of build it in parallel, and I think banks are aware that it's out there. They're not just going to sort of roll their eyes and go, we have an unbreachable moat, but I think they will bring people in to do that. And I think you've seen it. You said, Fidelity Digital Assets, massive player out there, hundreds of people working there. They were very early adopters. They provide a lot of custody now for some of these very big exchanges or ETFs that are popping up. So I think, the banks still have a lot to offer, and I think that a lot of that merging between the two will happen in the coming few years. And I'm hoping, and I'm assuming that that's the sort of area that you're looking at. I mean, do you want to just give us, you sort of quickly mentioned when you were chatting about failed trades and all this sort of stuff, anything you could sort of add on to that sort of thing? I mean, what do you see that you can add from that perspective, or the sort of crypto space can add to that perspective?
Yeah, I think it's not so much what it's more to do with the fact, I think, the business model. So I think if you look at you and I work for a large global investment bank for many years, and if you look at most investment banks today, to take an example, anything up to 10,000 trades fail a day. And if you look at ESMA statistics on for example, corporate bonds are 3%, equities are 6%. Those fails are for a number of reasons. Part of it is because the technology upon which I think organizations generally, you talked about banks, whether it's investment banks, commercial banks, etc., that infrastructure tends to be often a couple of decades old, with technology built on top of what potentially is a relatively archaic infrastructure. And you tend to have, for example, as you recall, Damian, in traditional organization, you have multiple verticals, be it equities, derivatives, fixed income, treasury, etc. And then you have middle office, back office, product control, financial control, internal audit, operations, settlements. So you have this matrix of, some of the investment banks we know have 2,000 to 3,000 platforms, right? Because, and that's just been going the way for decades. And then you have the whole T+2 system where people are basically trading on margin, and there's often, just because of the nature of the model, you have people selling securities that, for example, they just don't own, and you have people buying securities where they haven't got the cash. So the broker playing principal all the time is having to step in the middle, and then you have the CCP effectively trying to novate those trades. I think a lot of that is to do with, I think, the funding model, and also the way that when you trade, you don't actually settle. So what we try to say is, okay, we need to move to a platform where it's effectively fully funding. We'll talk about netting and stuff later, but a fully funded model that enables you to, when you trade, you settle. And when we talk about settling, we're talking about settlement finality to comply with the directive. And settlement finality means effectively you've taken care of counterparty risk. And it means reconciliations are immediate. And let's just rule out fat finger trades, okay? We're talking about the fact that just like if you go on to, for example, Binance, you can't sell BTC unless you've got BTC in your wallet, right? But basically, that's the fundamental structure of the transaction. You can only buy things with the cash that you've got. You can only sell things with the assets that you have. And capital markets work efficiently, you could argue, because they allow you to have this opportunity to leverage and scale and buy on margin, etc. The downside is that the broker is acting as principal, and you're having anything up to 6% fails, which is just, in my view, it's just completely unacceptable. So I think shifting towards that fully funded and moving a lot of the post-trade to pre-trade can basically start to overcome those issues. And again, let's be really specific about this. I don't think that anyone should be endorsing or looking at some form of big bang overnight evolution. I think when you look at broker, exchange, CCP, CSD, registrar, nominee, banking rails, fiat, you're going to have an evolutionary process that we see going through a number of phases to basically start to see, in our view, more and more stuff effectively go on chain and basically collapse that financial markets infrastructure. And look, the banks, they can see the future. You saw Boney come out a couple of weeks ago. They're going to start providing custody for BTC. I think this is all just part of the evolution of adoption in the future. And banks know that they need to become much more efficient in terms of risk-weighted assets, failed trades, reconciliation. Our banks, we certainly have become, aware of, banks going into the overnight money market to fund the balance sheet, and perhaps because of the fails, they're overfunding or underfunding, they're overlending or underlending because of the reconciliation problems that they have. And I think that efficiency can be put in place, over time, and it will be, because the cost of capital is already high enough, and that needs to be fixed. So that migration to a digital platform, I think, is already happening, will happen now very quickly.
Yes, and I suppose, as you mentioned, if you're moving to that T instant settlement, you can remove a lot of KYC issues as well, because obviously you can make sure that you have fully KYC people before they start to execute. Obviously, the minute they have to have the cash somewhere to be able to execute that and swap a fiat currency for a security or whatever it may be. So it starts to, I think a lot of the initial scaremongering around Bitcoin, I suppose specifically, and some of the other altcoins, was about it's a way to hide your tracks, etc. But in fact, what a lot of people don't realize is that because of the nature of the chain, all these, it is recorded now. As long as you can map up the chain versus the person underlying it, then actually it becomes a much more secure and safe system. I thought that was really interesting what you were saying about.
I think that's absolutely right. Yeah, I think you're absolutely right. You hit the nail on the head. Yeah, and I think it's something like 1% of crypto transactions. This is your domain, not mine, Damian. I think 1% of crypto transactions have been linked to perhaps either skullduggery or poker or whatever. But as you said, everything is immutable and actually can be traced. And when you see companies like chain analysis and the technology that's now being deployed, I think it's becoming safer and safer. But ultimately, if you're cleared and you're eligible, then you should be you should be able to crack on and get going. Completely agree.
Yeah, interesting, and very interesting what you were saying about collateral and actually collateral efficiency. I suppose that it would bring down the line if you're getting all these failed trades, as you say. People I'm sure post extra margin to just try and cover that, and if you can remove a lot of that.
Yeah, you're right. It is. Yeah, it is, and I think, and you touched on an interesting thing, because I think there are a couple of fundamental, perhaps misunderstandings out there at the moment. I don't think people fully understand always that brokers are acting as principal. I think that's now with Robinhood, people understand that that brokers actually act as principal, and I think that's the first thing. And I think the second thing is central counterparties who play obviously a very important role. I think that there is an assumption that they financially and legally guarantee the transaction, and in fact, actually, they don't. So when you have a systemic dislocation, whether it's Lehman's, or potentially what could have happened, with GameStop, etc., with those events, what tends to happen is the waterfall kicks in until you get to the person who's basically getting caned, and often that's the investor. So if you are a regulator and you get out of bed every morning and you're worrying about investor protection and reputational risk and all those good things, then events like this are material. And I think probably what has happened this year already with GameStop and the Congress hearing and the CEO saying T+2 is just rubbish. It should be T+1. I think and DTCC are even saying, okay, we're going to look at it. I think this could be the thing that actually acts as the catalyst to see this change.
Yeah, and I think keeping on the GameStop theme, a lot of people were surprised, I suppose, as was I, to a degree, that more than 100% of the shares were short. Now, that's got to be due to things being lent and relent, and there being a bit of opacity around what goes on in a stock loan desk, for example, so that. And I suppose you saw it at Lehman's as well, not just on stock borrow, but there's a whole rehypothecation of assets because of the sort of the current system, which is basically based off a lot of netting. People net buys and sells to then settle at the next level, to then settle down to the custodian, to the counterparty, etc. So you could see that this would sort a lot of those types of issues out, because you would have finality of where assets were, where they've been lent. So it's not saying that this precludes stock lending or anything, but what it would preclude is things being lent and overlent and such like. So it does certainly solve a lot of problems for people.
I think that's right. I think I think again there's a couple of I suppose angles to hone in on. I think number one is what we saw with Robinhood, and we actually saw it March, April last year, is the clearers can demand more capital if they believe the market warrants it, and that is a key thing. So they can actually demand of a broker, we need more capital because we're worried about risk on, and that, as you saw with Robinhood, they had to find 1 billion to 3 billion like overnight. So that could have been a systemic risk, and I think that's one thing to focus on. And I think the other thing is when you talk about netting, etc., I think there's a couple of angles there as well. I think netting actually plays a very important role because it brings in HFTs and that brings in liquidity. Okay, and that is good for markets. I believe markets should allow longs and shorts because that's what makes the world go round. But I think there's a couple of things. I think number one is, I think in a T-instant model, okay, well, netting doesn't work, right? It can't by default. But there are two angles. I think number one is what you can do is you can effectively replicate that. So for example, here is a potential model, member firm, member client. Actually, the member firm can deposit capital, for example, in an exchange like ours with an account at the central bank that belongs to the member firm, but we have power of attorney over it. the member firm can then extend a loan, effectively leverage to their client. But an exchange like GSX can have the power that if Gamestop goes up 500% in a day, we can still affect the same safety, that you can basically stop things getting out of control. And if that margin is breached, you can then say, okay, we're going to adjust the trade. You're effectively taking out the clearer, but the rules are much more transparent. And I think that's absolutely vital. So I think that bilateral arrangement can happen very quickly. I think the second thing is, as well, as you just pointed out, when you look at the whole SBL market, and you've got something like 100 trillion of assets, of which something like 20 trillion are actually available to be borrowed and loaned. And in fact, only 2 trillion as a national securities lending website, 2 trillion are currently being loaned. So you've got this just massive pool of assets that aren't being optimized. And if they're not being optimized, there's a liquidity opportunity there to, I think, grow markets. And I think there's, let's take this really stupid example, okay? My mum owns British Telecom shares from 1984. She's never done anything with them. Okay, why not? She just sits there and sometimes gets a check land on her doormat, and I'm actually being serious. It is a check with a dividend for £2.69. Yeah. I mean, it's just utter, just utter inefficiency. And in fact, what she should be able to do is, number one, get her dividend on the same day in her wallet, right? Clearly, because that will help British Telecom become more efficient. It lowers the costs of everybody. And also, if she wants to, she should be able to, through a mechanism, be able to lend her shares if she knew what she was doing. Yeah. And she could, she's held them for 40 years. She may as well do something with them, right? And if she can put them on and that's what DeFi is doing. If she could put them on a board to say, I'll lend my BT for 4% a year, somebody might want to borrow those to short them. So we think there's a number of things, again, which will happen extremely quickly, which will drive SBL liquidity, on exchange, and also, perhaps remove that T+2 financial markets infrastructure and basically collapse the infrastructure to make it, lower risk, lower cost, much more efficient with zero fails. And that's kind of nirvana, right? And then I think, if we can move to that, which I'm sure, just about every stakeholder that's involved in that process, properly wants that to happen. And ultimately, where do you get to? Well, hopefully the regulators achieve what they want, which is to protect investors. When you look at GameStop and Robinhood, actually the people who got hurt were some investors, because some investors were suddenly found that they were liquidated their position, right? And it was like, how did that happen? Well, it's just what happens when you have events like this and collateral is put up, and Robinhood had to do what they had to do. It's not a criticism; it's the nature of the market.
Yeah.
I think a lot of that can be addressed, with capturing the innovation that we're seeing every day. And that's the amazing thing about what's happening at the moment, is the innovation is available to everybody to leverage, and that's just huge.
Yeah, and I think that was certainly one of the interesting facets when I started sort of down the rabbit hole, as it were, looking at crypto and then DeFi. It's just, you realize there's a lot of incredibly smart people that have started to move into the space. And I just think to assume a lot of people did a few years ago, that it was a kind of a flash in the pan and then it would disappear away. There's some incredible things being done by some of these individuals, some of these companies. They're looking to build a parallel financial infrastructure already. There's yield curves being generated, et cetera, that allow for pricing of options, that allow for pricing of structured products, et cetera. So some incredibly things being done incredibly fast. Obviously, as you say, it's not going to get implemented immediately into the banks, but I think it will slowly start to seep across. And I suppose that brings me to the next point, which is, obviously a lot of the work we do is much more around the sort of the review and control side of financial institutions. We've all come from the front office backgrounds, but actually then we're taking that knowledge and trying to plug it back into what they do on an internal audit side or a compliance side, for example. These departments, I assume, will need to retool to some degree. And you don't not everyone needs to know the exact mechanics of a blockchain to understand what's going on with it. But I think you'll need some sort of technical know-how within these departments. Do you see that? I mean, when you go to see some banks, are they starting to look? Are there sort of digital asset officers? I don't know what the key term would be these days in some of these financial institutions already.
Yeah, very much so. They're all incredibly invested and advanced, and looking at how they can apply and deploy that technology to make their organization more efficient. And I think one of the challenges that the current financial system has, and this is obviously a bit of a pain point, but if you like, middle and back office reconciliation is an enormous function, right? And I think that's a big opportunity for efficiency there, because if there is no reconciliation to be done, because when you trade, you settle, and the reconciliation is therefore done at the point of trade, I don't think it changes in any way the three lines of defense. I think that's absolutely as valid as ever. What you're doing is, and this is what I always try to think of it, is a matching engine is a matching engine. You're trading off chain. It's got nothing to do with the blockchain. What you're doing is you're taking the plumbing, the post trade, and you're basically just using that, we think, in a more efficient way, and also creating immutable data. And that is really, I think, interesting to regulators who can pipe into ledgers to see the data, instead of, as you know, under MiFID II, you have to push the data, and if you don't, you get a slap on the wrist. All that stuff should be able to be, and is being automated very very quickly. So I think you're right. There'll be some retooling that needs to happen, but ultimately, what are you looking for in your three lines of defense? You're looking for the control environment to be as robust as possible, and to make sure that you're complying with the regulations. And I think one of the challenges that I think, and I'm sure you're seeing this too, is how do the regulators innovate to get their arms around DeFi? Whereas you say, under MiFID, you have to have a balance sheet of 75 million euros, or you have to be a credit institution to write a derivative. It seems that in DeFi, you can do what you like, right? So that investor protection angle, I think is critical, because regulators are going to have to, I think, move relatively quickly and innovatively, and think out of the box in order to get that protective control environment moving at a speed at which this parallel universe is growing. I mean, it's just exponential, right? So and I think it's very doable. There just needs to be alignment, I think, very very quickly, because at the moment most of DeFi is in bearer assets. It's not going to take long until that extends into potentially registered, and that, I think, is the opportunity, I think, for the regulators to really get involved and create that framework, which I think will become so powerful.
Yeah, no, that's very true. Yeah, no, that's really interesting to hear, and I think you're right. I think, and I'm pretty sure that the regulators have having a very close look at this already. I mean, I think there's been a lot of positive moves, or positive sounds, I suppose, towards the crypto space. I think it seems to have been accepted now, or to certain degrees of it have been accepted, rather than just pushed away. We'll wait to see how that sort of develops. I mean, is there anything else you want to bring up, Nick? I think we've covered a fair bit there, and we could sort of get into the very detailed mechanics of the plumbing, but I think it's been quite useful from a sort of broad brush point of view to really touch on a few of these areas. I don't know if there's anything you feel we've missed, or anything else we could add.
No, not at all. I think it's absolutely spot on. I think I think we've seen a let's just say almost, if you look at the crypto markets, we're moving into now that second phase. I think the first phase was crypto markets growing, and COVID happening, BTC going from 19,000 to 3,000 in a matter of a day or two. But what you've also been seeing, that volatility was, I think, very painful for some people, but you're seeing now the big exchanges take control. So that's your classic maturing of an industry and a sector. But alongside that, you're very much seeing the decentralized platforms now create that next wave of evolution. So I think what's a really interesting time for all of us is that we've been sort of talking about digital securities. We've been talking about the evolution of distributed technology, etc. And I think what we're seeing now is this. Now it's actually starting to get really, really real traction, and I think this sort of 5-year cycle that we're about to go on. So if you think that when we were messing around with Coinbase in 2015-16 with this BTC asset-backed security, we're now going to the next 5-year cycle where you've got proper maturity. And we were talking to, in fact, one of our advisors who's helping us with our tech last Friday. And when you talk about looking at DeFi and perhaps working with some of those protocols, you have 10 million plus people on these platforms doing stuff every day, and that is growing so quickly because people are getting up the curve really quickly, and I think that's what's so exciting. So I think this shift is real, and I think the timing is wonderful, and I think we're going to see. You're always going to have bumps because when you've got regulations and innovation and technology and speed, those things are often difficult to manage. But I think everything seems to me to be moving in the right direction. And you've got ultimately a great opportunity for issuers to get access to capital efficiently, investors to get access to some really cool stuff. And I think those things that we talked about earlier in the call, that if you can make markets, just deploy innovation to make them more efficient, where you remove those fails, you move that counterparty risk, and you start to drive, if you like, register of member on chain, then you're starting to get some really good things happening, And I think if if you think about it today, here's a really stupid example. Okay, so if you had to ring the airline to book a ticket, ring the airport to let them know you're coming, ring the airline lounge and say, can you reserve a seat for me? You're dealing with, at the moment, with 3 or 4 different financial market infrastructure players. And straight away you can see there that that's just wholly inefficient. And in fact, what you do now is you go online, you book your seat and everything else happens. So that, I think, is where, if you want a really sort of layman's look at financial markets infrastructure, I think that's where we'll get to in the next couple of years, where actually everything is done instantly with effectively one provider. And that's where, it's almost like booking.com, right? They just take care of everything. And that's these exchanges will evolve very quickly, and investment banks and banks will evolve very quickly, and investors and issuers get access to a more efficient market. And ultimately that's got to be a good thing, I think, for control environments and compliance and all that good stuff. So it's a good time.
Brilliant. All right, Nick. Well, thank you very much for that. Very good to get
Pleasure.
hold of you over in Gibraltar.
Thanks, Jack.
And hopefully we'll speak again soon. But brilliant. Thank you.
Thank you for listening to episode 10 of the Skadi Podcast. Stick with us on this journey as we, like many of you, are trying to navigate out of the pandemic. This is the Skadi Podcast.